All right. Hello, everybody. Welcome. Thank you so much for being here today for today's webinar, How to Fund Your Endowment, a framework for small and mid-sized nonprofits. And we're excited that you're here. Uh, we'd love to hear where everybody's from, so let us know in the chat down below and where you're calling in from, what your organization is. And today we're going to talk about something that might feel a little bit out of reach for some, maybe a bit intimidating, and we get that. If you've been in nonprofit leadership for any length of time, you know the cycle. 1 year, you finish in the black. The next, you're shooting over budget. A surprise bequest comes in, and then a core grant gets cut. Your gala smashes every fundraising goal you set, but at the same time, it feels like some of your bills have doubled. And this financial whiplash can be pretty common, but it can also keep your board, your staff, and let's be honest, you lying awake at night. Raise any virtual hands if anyone else relates to these. We've definitely heard plenty of it before. And here's how that feels. On the good years, you exhale, you finally feel like you can breathe. And on the lean years, well, you're feeling the pressure. And when the idea of an endowment comes up, the questions start, are we really big enough for that? Or won't this take money away from our programs? And that's exactly what we're going to review today. Our goal today is to show you exactly how to take those first intentional steps, no matter where you're starting. If all you have is a modest surplus this year, we'll help map a path. If you already hold excess reserves, we'll show you how to formalize them. And if you're cultivating donors who dream big, we'll outline how to invite their partnership. So, before we dive in, just a couple of quick housekeeping notes. First, we are recording this session, so there's no need to take any sort of furious notes. We'll email the recording to everyone who registered, and we'll also pop this on our nonprofit YouTube channel too. So hello to all the future viewers. Second, we'll have a Q&A at the end, so if you have any questions along the way, just feel free to drop them in the Q&A panel as they come to you. We'll keep an eye on those and make sure that we save time to answer them at the end. So, before I hand things over to Megan, let me give you just a quick snapshot of who we are at Carnegie and why we're having this conversation today. So Carnegie is a registered investment advisory firm, and we're headquartered in sunny Cleveland, Ohio. We work with nonprofits all over the country in many different sectors, and we manage about $6.5 billion of assets for individuals, institutions, and organizations like yours. We abide by the fiduciary standard, which, simply put, means that we are legally and ethically required to put our clients' interests first, always. This matters a lot, especially when you're managing charitable funds. And to toot our own horn, what makes us special is that we go beyond just managing investments, which anyone can do, and we actually help nonprofits think strategically about their financial future. And we offer tools like this webinar to support your fundraising efforts and long-term sustainability. To introduce who you'll be hearing from today, my name is Chris Carey. I'm Vice President, Portfolio Manager here at Carnegie, and I work closely with nonprofit leaders to help them build and manage their investment strategies, especially around endowments. And today's webinar is rather special because if you've been following our series of webinars from the beginning, I've had the pleasure of presenting every session so far, focusing on everything from investment management to the governance side of things, investment policy statements, when it comes to, those sorts of things for nonprofit financial management. And you can watch those back on our YouTube channel, and we'll link that in today's follow-up email. But today, we get to hear from my wonderful colleague, Megan Lankowski, who focuses on the development side of our practice. Megan is our nonprofit development specialist, and she brings a wealth of experience helping organizations grow donor support and communicate effectively about their long-term fundraising goals. And we've teamed up for today's session to walk you through the practical, actionable ways small and mid-sized nonprofits can start or strengthen their endowment, whether it's board designated or donor designated. Megan, let's start with talking about why an endowment really matters for nonprofits. So with that, over to you.
Well, thank you, Chris. And I've enjoyed being your host, but I enjoyed taking over the thought leadership seat for this webinar and really developing this strategy for small and mid-sized organizations. So let's get into why does an endowment matter for your nonprofit? And of course, we'd all love to just have an extra $1 million sitting in the bank. But what does building a fund like this, even if it is small and strategically, actually mean for your organization? So, first, it's about predictable mission fuel. So, an endowment can create a steady stream of support that you can count on, even when your annual revenue seems like it swings up and down every year. Of course, this works best when you use prudent assumptions and make sure that your approach aligns with your investment policy statement and your state's UPMIFA guidelines. But by really managing it responsibly, you can create a sustainable funding stream for your organization that you're able to decide what you want to use that funding on. And I know that's something that the nonprofit world is weird that we receive funding that we don't always get to decide what we're actually spending it on. That's one of the great parts of a board designated endowment fund that we'll talk about today. So, second, it tells a stronger story to your funders and donors. It shows that you have disciplined stewardship and that you are thinking long term. So, it's communicating that you're protecting their investment in your mission, which essentially is their donation, is an investment in your organization, and that you're not just focused on this year's goals, you're focused on the long term. And lastly, your endowment gives you the freedom to make strategic choices. So it gives you the ability to keep a program running if a grant lapses. It means that you can hire or maybe keep the key talent that is running your organization. And of course, that happens, or and I'm sorry, and it also lets you bridge those timing gaps in your funding cycle where maybe you're waiting for grant funding to come in, but there's a few months where you're not, where you that program isn't funded. So I did want to address this because I hear this statement a lot from organizations. I think we're too small for an endowment. And honestly, I completely understand that because I felt that way too. I worked as development director and COO for a nonprofit domestic violence shelter for 9 years. And we had about a $2 million budget by the end of the time that I left. And even then, I thought, that an endowment was for bigger organizations. That's for the United Ways and universities and hospitals. That's not for something for my local nonprofit, right? But here's the truth is that it's not about having it all figured out today. Just like with our personal finances, it's about being responsible and intentional and starting where you are. Then you can build on it over time. So now, fast forward to now, I get to work with organizations of all sizes, large and small. Now, I use the term small very loosely because small is so relative. We talk to organizations that have $10 million yearly operating budgets and they're thinking that they're too small, all the way down to a nonprofit that you'll hear about today that operates with less than $100,000 annual budget. And so it's less about your budget size and it's more about your mindset and your willingness to plan for the long term. And spoiler alert, that domestic violence shelter that I worked for that I thought was too small did start an endowment, and I'll share more about that later today. So today we're going to explore two paths that you could take to start building an endowment. There are board designated endowment funds and there are donor designated endowment funds. And the good news is you don't actually even have to choose just one of them. These can really work together. Your board can establish and begin contributing to a board designated endowment fund. And then over time, you can invite donors to contribute to that same fund or even create their own donor designated endowment fund to support your organization. But that conversation could be fueled by the fact that you have already started one. So, really, the key is that you start now with what you have and then you build support as you go. So, first, let's talk about board designated endowments and what makes these differently. So, this is money that your board chooses to set aside for long-term use. So, unlike a donor restricted endowment, the board has the authority to adjust it or even withdraw from it if circumstances require and your policies are written in a way that allows you to do so. So, why does this matter? Well, it means that you can start building a financial cushion today without waiting for $1 million transformational donor to pop up at your door. And so you can use the resources that you already have to begin securing your future. Even small, steady set asides can build the stability you need over time. We I wanted to share this example as I sprinkled in earlier. When I was working as the development director for a domestic violence shelter, we did not have a major donor that started an endowment for us. We had a few years of surplus that led to our reserve fund being well over the amount that was required by our bylaws to have in our reserve fund. And this led to our conversations of what would a board designated fund look like. It took a few more years for us to save up enough. We felt like we had a good chunk of money that we could then invest. Now, I would say if I was able to go back in time, I would have had us starting that fund and investing that money earlier and having it work for us. But the point is that we started this, not this endowment from slow contributions from the board over time. And I'm very close still with the CEO, and I just spoke with her a few weeks ago. And that when I left, the endowment was almost at $1 million. I just speaking with her a few weeks ago, that fund is now at $2 million. So I'm so proud of them for putting in those steps for their organization's future. Now, I touched on this briefly, but I did want to make note that this is not about draining your reserves to build an endowment. You still need to keep in your reserves enough so that your organization can weather a short-term storm. That's what allows you to pay your bills, make payroll, and keep operations running, even if funding is delayed or a major expense pops up. So I want you to think of it this way. Your reserves are your emergency umbrella. Your endowment is your long-term security blanket. You really need both of them, one to protect you in the moment and one to safeguard your mission for the future. So let's talk about some common misunderstandings that I often hear from nonprofit. One is that it locks up our cash forever. Now, this is a common one and it does not give the entire picture because this is a board designated, not a donor restricted fund, your board can revise or release the funds at any time if circumstances require it and your policy allows for it. That's why it's so important to craft a policy that allows your board to have this flexibility. And when you're working with a financial advisor like Carnegie, you can discuss and plan for cash flow and liquidity needs that fit your organization's needs. So, second myth, we need six figures to even start. So, the really cool thing about an endowment is that there is no magic number to get started. You can open an investment brokerage account and begin with whatever amount you have. Then you'll also be ready for those stock gifts too. If you'll have a brokerage account ready to transfer those stock gifts and make a nice easy donor journey for your major donors. Now, when you're choosing where to custody your assets, I'd like to note that you pay close attention to fees. For organizations that are just starting out, we often recommend the custodians of Charles Schwab or Fidelity. Both of these offer low fee options, and Fidelity has account options with no minimum account requirements. Charles Schwab does, I believe, often have some minimum requirements. So you'll want to double check on that to see if you meet them. But both of these custodians also allow investment advisors like us here at Carnegie to be given limited power of attorney, which you can grant and also remove at any time. And that allows outside investment advisor to help you manage and govern those assets for you in a fiduciary capacity. Next myth. If we commit to setting aside a certain amount, then one year we can't, well, we're just stuck. Again, the truth is you are not locked in. Your board can defer, reduce, or skip a planned contribution when it's prudent to do so, and your policy allows you to do so. The key is to build that flexibility right into your policy when you're creating the fund, document those decisions, and always protect your liquidity. So, really, the takeaway here is that a board designated endowment is not meant to be a trap. It's meant to be a tool for your organization. And they're designed to give you stability, not to box you in. So, let's explore some ways that you can find some potential seed money to start your endowment fund. So you could have maybe a year-end surplus, even just a small margin can work. Putting a set aside your small surplus and continuing to do that when you do have surpluses at the end of the year is a great way to start building an endowment fund. You could have a board member challenge, which I thought is a really cool idea of a way that you can have the conversation with your board if everybody agrees that they want to invest this into the organization's future, and then use your board to move that forward and tap into their networks, make connections, make referrals, help me have meetings, have parlors, small parties, as have become really popular, and ways to bring together funds to start this board designated endowment fund. Another way is reallocating your excess reserves. So if you may have more that you may currently in your reserves have more than you are required to from your bylaws, and that has extra funds in it that you're not going to need for the short term. So you're able to reallocate that into an endowment fund for your organization. And then lastly are individual donors. And I brought this up because I think oftentimes we think an endowment is a donor designated endowment and it comes from one donor that starts one big fund, one donor that comes and donates $5 million, and now we have an endowment fund. But the thing is that you can start a board designated endowment fund and have conversations with individual donors to help contribute to that fund. That doesn't put it all on one donor that they have to be the one to start the fund. The fund is already started. We're now having conversations with donors to attract money to that fund. And it's all about how you have that conversation with those donors that can really help bolster this account from you. And we're going to go into more detail on that when we get into talking about some of the donor designated funds. So once you have your seed money to start your fund, you could also choose a contribution rule that you can continue to build on that fund year after year. So I'm going to share a few of you'll see on the screen a few starter models, but you may choose your own or maybe even combine a few of these to fit your organization. So one model is a flat transfer. The board votes to move a fixed dollar amount into the endowment every year. So that's simple to budget for because you know exactly what the number is going to be. Now, the downside is over time, as your organization grows and so does your budget, that number should grow also. So you'll just want to make sure that you revisit it periodically and adjust your transfer rate. Another model is a percent of surplus. So at the end of the year, you move a percentage of any positive year-end balance. This scales with your performance. So in strong years, you can contribute more, and in lean years, it allows you to contribute less. The watch out here is really that it requires discipline at year end to figure out what that number is and then actually make the transfer before those dollars get absorbed elsewhere. We know how quickly that can happen. So, lastly, the last model is event triggered. So you deposit any unrestricted gift over a preset threshold. For example, anything over $50,000 goes straight into the endowment. This captures windfalls that you weren't counting on. So you weren't counting on that money in your budget. It wasn't already spoken for. So let's get that into savings, into investing for our future before it gets gobbled up with all the other things that we want to spend it on. Now, the trade off is that one, it's less predictable for planning purposes because you can't control when those big gifts arrives. And you may not necessarily want to for sure contribute all of every major gift to your endowment. You may want to, it may come down in that moment. You actually really could use half of it for to pay for a new hot water tank, and then the rest of it can go into your endowment. And so that can be a restriction in that case. So once you've decided you have your endowment set up, you know how you're going to contribute, you know how your board wants to continue to contribute to it and support it on an ongoing basis. One of the best ways to keep your board and stakeholders excited about it is to actually show them progress, because the novelty and excitement after those first conversations can wear off quickly. And so we want to make sure that people are still aware of what's going on and see the progress that's being made. So, a few examples of some visual ways that you can use to show your board and key stakeholders the momentum that you're building with your endowment. One is a reserve ratio chart. So this is just your endowment balance divided by your annual operating budget. So seeing that ratio go up over time shows that you're building stability. That's really cool. And eventually, hopefully, you get where your endowment, is the fund exceeds your annual operating budget. Not even necessarily saying that it's paying for your annual operating budget every year, but having a whole fund that is the same amount as your operating budget, it would be really cool to show board members. You can show a bar graph of program spending versus annual set asides. So that's just a quick way to show that you're still investing in programs and setting money aside for the future. That could be really helpful for board members who are maybe a little wary about setting money aside for the future when there are so many immediate needs right now. And that showing them that we are still contributing a lot to programs as well, but then this money is also protecting our programs for the future. Lastly, we have 5-year projection table. So you start with your current balance, and then you add your planned contributions and apply a conservative growth assumption for the next 4 or 5 years. And when I say conservative, I mean prudent, because this isn't about making promises. This is about setting realistic expectations. But it would be nice for board members to see what the plan is of where you're trying to go. So these clear visual progress reports really just helps to build trust with your key stakeholders and your donors, who are probably the people that are often sending you major donors and making those introductions for you. All right. So we have talked about board designated endowment funds. And the beauty of that approach is that you can start building stability with the resources you already are in control of. But that is really just one path. So now let's take a second to review board designated endowments. So I feel that when most people hear the word endowment, I think they're thinking of this version. In simple terms, a donor makes a major gift and asks that it be invested for the long term with a clear purpose in mind, often with restrictions on what the fund can be spent on. Now, the nonprofit is required to document that intent in a gift agreement and required to honor those donor wishes for the entire life of that fund. There is an act called the Uniform Prudent Management Act, or the Uniform Prudent Management of Institutional Funds Act. UPMIFA is the abbreviation. And if you do receive a board designated endowment, MIFA is an act that outlines what prudent management of those funds look like. And you are required, if your state has adopted MIFA, which to my knowledge, as of this date, almost all have, that you're required to follow those guidelines. And in within those guidelines is, of course, remembering to honor the donor wishes and their intent for the life of the fund. So, so here's what makes donor designated funds so valuable. One, they can be catalytic capital. They can give your endowment a jump start and create momentum with your board and the community. You can share the stories, share the excitement, really, and attract more money to it as well. But really, it gives you one leap ahead than starting with just small set asides. They also align with donors' legacies and values. And so that deepens the relationship and sometimes can lead to even more support over time. They also offer storytelling power, like I mentioned, that you can share this impact story with other donors, with the public, that will hopefully inspire other donors to support you in the same way. But there are also important considerations with donor designated endowment funds. Restrictions can limit flexibility. You have to use the funds in line with donor intent, and that can be restrictive. It could also not be if you have the right conversations with your donor and you have the right donor that's open to you using those funds as you see fit. Those are all great conversations to have. Another in consideration is that there is ongoing stewardship obligations. So you'll need to provide reports, acknowledgments, and consistent communication with your endowment donor and possibly their family. And the timing is unpredictable. So these gifts can be irregular. So you can't build that into your operating budget ahead of time. So that is another consideration that they're going to arrive, on their own schedule. So, one myth that I wanted to talk about with donor designated endowment funds is that, oh, we're too small to attract a major gift. We'd love to get a major donor, or we'd love to get a major gift, but we're just too small. We don't have a planned giving department. We don't have a major gifts officer. But the truth is that you do not need any of that to get things started. What you do need is readiness, clear language, and follow through. Readiness means that you have the basics in place so when a donor shows interest, you can act quickly and confidently, and you know the people to reach out to help you move that forward smoothly. Clear language means that you are able to explain what an endowment is, why it matters for your organization, and what impact it's going to have on the mission that you serve, and how that donor can easily contribute to it. And follow through means that you keep your promises. And we know that that is so important in donor relationships. So whether it's reporting back, acknowledging the gift, honoring the donor's intent for years to come, or keeping it anonymous, those are all important ways that you can follow through and show up for your donors with what you said that you're going to do. So small nonprofits can absolutely attract major gifts. And I've seen it happen many times, not because the organization had a huge development team, but because they were prepared, they could communicate their vision clearly, and they followed through and did what they said they were going to do. So I do have a few real examples of donor designated gifts. And these are from, again, quote unquote, small organizations. So the first is Help Kids India. This is an entirely volunteer run nonprofit with a relatively small annual budget. Last I spoke with them, it was less than $100,000 a year was their annual operating budget. They do incredible work. Quick shout out to them. They provide education for children in India who were born into poverty. Back in 2008, they started funding a preschool. And in those early years, it was definitely a little dicey to financially. And then they added two more schools, which was a really big expansion for a small or nonprofit with no development team to spend time raising funds for these extra schools. So one amazing board member and her husband stepped up and they made an endowment gift that allowed the entire team, again, all volunteers, to breathe a little easier. This endowment is not so large that it covers their entire budget, but it allows them to weather unexpected expenses and breathe a sigh of relief if a funder does not come through one year. They can feel confident knowing they have a financial cushion to continue serving their mission, even if and when, let's be honest, unexpected expenses arise. And now the fund exists for other donors to learn about and support and contribute to, and for hopefully it to grow in the market for them. So, again, this is just such an amazing organization. The children they serve come from families with very little, and even the staff are not well off. And so, this fund really helps to give them some security that and confidence that they know that their school is going to be here next, to be there next year, which is, something that I know I took for granted growing up. Another story that I wanted to share was from my time as development director. So, when I was working at this domestic violence shelter, one day a man walked in to our office and he looked like he'd been working on a farm. He had some ripped up clothes. If I'm being honest, he looked like more like he was there to ask for help than to give it. But he showed up and asked to speak with the CEO, who is wonderful, and came right out and spent about 30 minutes chatting with this man. They talked about our mission and our programs and what we were doing and the local community. And toward the end of the conversation, he shared that he had just come from another organization that he walked into and asked to speak with someone. And he sat there for 2 hours without anybody ever coming to meet with him. And so he eventually left and walked into our doors. And then he told our CEO, I have $141,000 of stock that I'd like to donate. And that moment taught me two big lessons. First, it is never judge a book by its cover. And second is that you never know when or from where a major gift could come. So it's always great to be prepared and to have these conversations with your board and leadership beforehand so that you're able to know what to do when those things come in. That major gift was split up into paying for some of our programming and then also going into our surplus to help build our endowment fund. So before you think, okay, I need to go find a bunch of new donors to support my endowment, let's mine the gold that you already have. This is the hill that I will die on. In almost every donor database, there are a handful of supporters who are already primed for an endowment conversation with you. You just need a way to spot them. And here's the good news. You don't need any new fancy software or a big development team to do it. Just your existing CRM and some simple reports and a worksheet that I'm going to share that we'll share with you. You can use those tools to look through your current donor database and identify prospects that are warm for you to have these types of conversations with. So honestly, I was going to walk through this whole exercise live with you, and it just made the webinar way too long. So what I did was I condensed it all into a worksheet that I'm going to share with you after the webinar. It'll come in the email with the webinar recording. So the goal here is really to do this exercise and to come out with a short, highly targeted list and a clear reason of why each person is on that list, of why they are a great prospect to have these conversations with. That way, when you start reaching out, you're not just calling at random, you're reaching out to people who already have the loyalty, the capacity, and the connection to say yes. So at a high level, I'm going to walk through what this exercise looks like, and then you'll be able to dive in specifically for your organization and your donor database with the worksheet. It gets into the nitty gritty and is pretty tactical. So again, that's why I couldn't go through every single step here live. But you're going to start with pulling key reports. So, pulling from your CRM or finance system, you're going to pull reports that look for consistent giving, high capacity signals, strong ties to your organization, and any asset friendly clues and notes that might be a clue that they have that they have the capacity to support your endowment. Next, you're going to build your hot list, as I called it. You'll combine these reports and you're going to flag overlaps. People that have donated consistently to your organization that actually increase their giving year over year, that have emailed you asking about gifts of stock or have donated from their donor advised fund, people that have attended multiple events and have made referrals for you. You're going to identify these individuals and then have a list of 10 to 30 names, with each one with one line that also says why them. Then your last step is going to be start to nurturing them. So I would love for you to commit to a certain amount of time, weekly, biweekly, monthly, that you can commit to spending time nurturing and cultivating these donors. So, like I mentioned, this worksheet is very tactical and walks you through exactly what filters you'll want to pull, what export columns you'll need, and how to flag them as warm, hot. And so, check your inbox after the webinar for this worksheet for you to dive in. I'm estimating that the whole exercise would take about an hour to set aside time to do it. All right, so now you have this list of wonderful people that you can reach out to. Now what? The key here is to move while the list is fresh in your mind and your momentum is high. You just had conversations with leadership, you're feeling the momentum. So, as I mentioned, try to commit a set amount of time once a week or biweekly to invest in this project. It will pay off in the long run for your organization. So, when approaching these donors, here's a couple tips on starting this conversation. This is, of course, assuming that you have some sort of relationship with these donors and feel comfortable asking to have these conversations with them. If you are not to that level yet, spend some time just getting to know them so that you can really have a deep connection with them. So when you are starting these conversations, you can open with something true about them and their giving or involvement. So it could be, I've noticed how consistently you support our programs. Remember, you're acknowledging, you're not pitching. Then let's paint the long-term vision. We're working on a fund that will that will underwrite our mission every year, hopefully forever. Remind them of the impact that they've had and how grateful you are, and then how your vision is moving forward and how they can be a part of that part of your organization as well. Then ask permission to keep talking. No, you don't have to introduce numbers or pressure or anything right now, but would you be open to a brief chat about some ways supporters are seeding that fund? Things like stock gifts or future bequests. Remember that bringing up bequests and estate gifts can feel a little weird. However, especially for organizations that don't have a planned giving department and they're not doing this all the time. But I want to remind you that everybody needs to have end of life conversations, and that a lot of people actually want somebody to bring it up so that they can talk about it, because we all might feel a little weird bringing it up. But this is a universal truth that we all must go through. And so if you can help your donors be better prepared, then that's a responsibility that we have to educate them on how that they can be better prepared. Oh, sorry, I forgot to bring up my last bullet here, but that is about painting that vision for the future, where we're talking about impact, legacy, vision of the future and where you guys are going to be going. So another way to attract gifts to your endowment fund is to capitalize on trends and talk about it in the campaigns you're already doing. So you don't have to launch another campaign. You can link to it in a landing page that talks about your fund. You can add a short PS in your year-end appeal letter. You could highlight the fund or the donor of a fund of that fund at a fundraising event or a gala. You can talk about it in your email newsletter, list it as an option on your website donate page, include it on your remit envelope. Just make sure that you're talking about unique ways to give, like gifts of stock, bequests, and that you're talking about your endowment so donors know that it exists. If they don't know that it exists, then they can't support it. So using trends and social proof is a great way to spark endowment gifts as well. And why is that? And that's because social proof is powerful. People want to see that other people like them, so peers, fellow donors, community members, are also taking action. It makes the decision feel normal and safe and maybe even a little exciting, like, oh, I get to be part of this group that is doing this really cool thing. I want to be part of them also. There is a reason that why on every product website page you scroll through and there are testimonials and reviews and they are highlighting them hard. It's because social proof is such a powerful marketing and fundraising strategy. So here's a couple natural moments that you can capitalize to talk about your endowment or planned giving, bequests, stock giving. End of year, of course. I don't have that listed, but this is a reminder that 30% of all giving happens in December. And I think it was 10% happens in the last 3 days. So year end, talking about those about tax efficient ways to give is a great way to attract gifts of stock that can go directly into your endowment. August is National Make a Will Month. So we are towards the end of August now, but maybe for next year you incorporate that into your campaign. Or you wait until October, which has National Estate Planning Awareness Week. There's also Giving Tuesday. And another reminder that giving on Giving Tuesday, so donations on Giving Tuesday, have only increased every year that Giving Tuesday has happened. So capitalize on that and use it to your advantage. All right. So we have gone through a lot of talking about these two paths of starting an endowment, board-driven path and a donor-driven path. With these tools in your back pocket, you can start taking small intentional steps right away. But I know that we've gone through a lot, and I'm sure that there are questions. So I'd love to open this up. Chris, I haven't been in the chat or seen anything. Can I hand it over to you to let me know what's been going on?
I was going to say, you haven't been in the chat, but oh, I have. So,
Oh, good.
um, we have a few questions. I think actually the two of us can tackle them together because I think there are some that I might be better suited to answering, and some for you. So, selfishly, I'm going to go for one of the ones that I'm going to tackle first.
Give me a break.
Um, which is from Anonymous, and it says, my organization's outgoing treasurer budgeted that the development committee that I will chair will raise 60,000 next year, 70,000 the year after that, and 80,000 the year after that one. They're also responsible as chair for growing an endowment. So how would you balance those two competing interests? They'd like the budget not to count on donations so that large gifts can go straight to the endowment rather than offsetting budget costs. I think that's a really thoughtful concern, and it's one that many organizations face, and a practical way to handle it is to separate operating revenue expectations from fundraising for long-term growth. If the board is assuming that you're going to have a budget that is in around, that 60,000 to 80,000 annual development revenue range, you might want to set that figure as your baseline for annual campaigns or general fundraising, and then you can create a board policy using one of the methods that Megan mentioned earlier that designates large one-time gifts or transformational gifts going directly to the endowment rather than those being used as, a way to plug operating gaps. And this way, you're not building your operating budget on large, unpredictable gifts, and you're protecting the intent of growing your endowment. And some organizations also create a cap on how much of the annual fundraising can be used for operations, with the excess flowing into the endowment. And the key really behind all this is transparency. Align the budget with realistic, recurring revenue streams while formally directing extraordinary gifts into the endowment so that both goals can be met without competing with one another. So that's one question. And if you have any more questions, Anonymous, we have our email at the end, and you can always just reply to our follow-up emails, and we'll be happy to chat even
I, th-
further.
Chris, and I think I'd add to that, as thinking of it from like as a development director perspective of these goals have been set for me. I think where I would start is starting with those operating budget goals. How are you reaching that 60, $70,000?
Mm,
And actually mapping out my campaigns and my goals for those campaigns, and is there any room in those campaigns that actually my goal is higher than what I need to fill that 70,000, and it might be actually even focusing on one specific campaign per year to raise extra amount to then be able to support that endowment.
love it. Another question we received was they have a donor designated account, and they learned that the donor and her husband have passed away, and they've tried to contact their son and have gotten no reply, and that the designation doesn't meet the current priorities, and they'd like to convert some of this perceived money to a more general purpose endowment. What guidance do we have? Great question. We see this quite a lot.
Mm-hmm.
My first instinct is I reply with my email so that we can chat, because the answer of how it's handled in some cases is rather state specific. Um, and so because UP-MIFA was a framework that states then took and adopted, versus it being a law at the federal level, for instance, each state's law varies, but there are ways to be able to convert donor designated funds into general purpose when that program that they were set out to support is no longer, in the best interest of the organization, or it's no longer running. Sometimes it requires a court order. So we'd be happy to chat and just dive into the specifics with you. So please reach out to us. Okay, Megan, question for you. Um, they say, Anonymous says, you mentioned the powerful storytelling opportunity of large donor gifts. They've received 50,000 and 10,000 last year in gifts, and the $50,000 donor wanted anonymity. They have donor gifting levels on which they are mentioned as above $5,000, and there are only a few people above it. How can they responsibly use their gift for powerful storytelling, presumptively without revealing who they are?
Yes, and that's a great
Mhm.
point that some donors want to be anonymous. And actually, Chris and I were just speaking with an organization yesterday she said that she received a major gift that was anonymous, and it was a small community, and the donor overheard someone talking and thought that it was about her gift. And she came back and spoke with the nonprofit, and they ended up having to like reach out to this random person who confirmed that they were talking about someone else, about another organization. But it was a really scary moment for her, because she said, we got $1 million gift, and then I thought that we lost $1 million gift. But what I would say is that you do not have to share their name with sharing what the impact was that gift was allowed your organization to do. So with that gift, when you are telling the story on social, in your email newsletter, highlighting it at an event, when you putting it as a story on your website, if you have a blog, you can still tell the entire story of the donor, of how the donor came to your organization. Has the donor supported your organization for a long time? Give, maybe a brief overview, not getting too specific. We don't want to give away anything that would make it so that it's not anonymous, but you can still use general descriptions of the story that brought this donor to you, and what really resonated with them to make this gift. And then what is even more important is showing what this gift allowed your organization to do. You know, I always say that fundraisers are salesmen with harder jobs, because we don't give you a product or a service. We just want you to, we're convincing you to give us money to do good with. And so really that's what their donation is investing in, is that impact. And we as fundraisers have to basically take ourselves out of the equation and say, look what this donor did, even though of course we know it was our organization that and our program staff that are doing all this hard work. We have to say, you know what, look at, without this gift, we wouldn't have been able to feed these 500 families or purchase this home for a donor. And so sharing that story without giving direct details is still very valuable.
Lovely. Okay, we can still fit in a couple more questions before our 2 p.m. cutoff. So, another anonymous question is, we have a list and one line about each person on a hot list. We're comfortable to have conversations. We just need clarity from the board on the vision. Should these conversations all be over the phone, or would an initial email be better so these don't feel like cold calls and catch people off guard?
So, honestly, I don't think that there's any one right answer for this. It's more so about knowing your donors. But my initial instinct is that in today's world, a phone call just, I mean, it feels like you're the most special person in the world, because you're getting a phone call, not just an email that could be, that of course could be automated and mass emailed. And and especially with major, these are presumably major donors. I love the idea of phone calls. One of my friends, Cal, who is a fundraising consultant, one of her big programs is like 20 minutes of calls every week. They're only phone calls. If you pick up the phone and you end up talking to a donor for 20 minutes, oh, then you just made one phone call. Maybe you end up getting to talk to 4 donors some weeks in that 20 minutes. But phone calls, and really having one, actually even leading to one-on-one meetings, meeting them for coffee, meeting them in their home, meeting at the organization, and being able to give a tour. I know organizations aren't always allowed to do that. Again, at the domestic violence shelter, we did do funder tours sometimes that are required by foundations, but we didn't do individual donor tours because of confidentiality and not wanting to put the individuals that are staying in our shelter on display. But we could have them into our offices that was in the same building as the shelter, and show some of the artwork that the kids are making in art therapy. So having those, deeper, getting to connect with them on a slightly deeper level in person, if you're able to. Of course, you're not always able to do that, but if you are able to do that, that can really help to deepen that connection.
All right, brilliant. So, two more. We are a small nonprofit with an all-volunteer board for a summer camp for children with critical life-threatening disease. We have no staff, but are well established for over 34 years, and we have started a rainy day fund through our 5-year strategic plan. But now we want to start an endowment with this small amount. We also need to do more fundraising. We previously had a few stable funding opportunities and sustainer grants that have helped maintain the operations of the camp each year. But now we need to raise more money. So this question, even though there's more, I'd say, to this question in terms of overall nonprofit financial management, and sort of best practices there, I think we should spend our time focusing on the final sentence here, which says, what is the best way to cultivate our donor base?
Okay. So, I guess, and I'm not really sure from that if you have done any sort of cultivation. If you do, if you do send thank yous and if you have an email newsletter, I think I'll start with the assumption that you haven't really been doing any of that stewardship or cultivation, which is normal. We speak with organizations that have million-dollar endowments and are basically not doing very much stewardship. It's what they're working towards. But so I just wanted to let you know that if that is you, that is okay. That is normal. But of course, we want to make sure that those donors stay with us, right? And so the important part about donor cultivation for me is that your donors don't just feel like an ATM. You want to be having touch points, soft touch points with your donors that are not involving an ask to support your mission. And so, what those can look like are getting building an email list. So, if you do have a donor list, you could start an email list and provide monthly email newsletter updates so that they are updated on what's going on with your organization. It was really easy at the domestic violence shelter in the day to day. I saw our program staff who, they helped they would help a woman and her three kids who came to our shelter who didn't have a job, didn't have a car, didn't have a license, and they would help them job train and interview and get their driver's license and find a job and get daycare and then find a home and then find things to move them in their home and then help them move in and get them set up and then provide aftercare services. But like that's just another day for our program staff, right? They don't always aren't able to step back and realize how transformational those stories are. They're just on to the next, helping the next person. And so it's our job as fundraisers to share the stories that are happening in our organization with the donors and the outside world because they aren't able to see all of the amazing things that are happening every single day. And so there are different best practices, I would say, about touch points between asks. I'm comfortable with 3 to 5 soft touch points before that are in between every ask. So the idea is that it hopefully wouldn't be okay. In April last year, they give a gift, you send one thank you, and then a whole year goes by and oh shoot, now it's April again and we want to give them a gift. We would like for them to give a gift again, but we actually haven't spoken with them at all. Um, Find ways to incorporate in an email newsletter list on social media that could be sending impact reports or direct mail appeals. It could also be those phone calls, like I was mentioning. Maybe your top major donor donates in April every year. Set a reminder in July, August, September to just have a phone call with them just to update them on the status that their gift is making, that on the impact that their gift is making, and
Brilliant.
just share stories.
Love it. Okay, before our final question, we'll have just a minute to tell everybody what we are going to be covering next month. So stick around for that. The final question we're going to answer, and I think we're going to answer this in tandem, Megan, with the minute, 60 seconds we have left. Any tips for fundraising for an endowment for a volunteer fire department that operates both on donations and town supplied funds? My first half of the answer is chat with us because when you receive state and local funding, sometimes there are, and you're a non-profit organizations, or you're partially nonprofit, partially run by the government, there are certain additional restrictions you have to keep in mind in terms of what you can trade, where the assets can be held, so on and so forth. So please reach out to us. That Megan, any thoughts for
I
Tom?
really, what came to mind is, a fire department, really, you're protecting the community. And so, ways that you can involve the community and also be involved in the community. Also, that educating the community that you accept donations, because I'm thinking right now, can I just donate to my local fire department, or do they have to be set up in a certain way? Like, I am not sure. I wasn't aware that I could donate. Now I'm thinking, can we just make a donation to like our police departments? That opens up a whole new world. And so I
Mhm.
would say that starting with educating people and even just going to local community events and having a booth, hopefully people would give you one for, possibly saving their lives at some point, that you can staff and just educate people that, what, we're starting this endowment fund, or just that we accept donations at all, I think is a
Yeah.
great place to start.
So thanks again for spending time with us, and thank you for all the work that you do every day. Have a great rest of your week, and goodbye.
Thank you, everybody. Hopefully we'll see you next time.
Cheers.